Good morning, everybody. So I am Gary Snyder, I'm Audit Manager. I joined SEK in 1996, so I have 25 years of experience with various nonprofit entities, including health and welfare organizations, as well as other nonprofit organizations. So today we're going to talk about three different topics. These are accounting and auditing updates that are coming up within the next few years, just so everybody needs to be aware of. The first one is the leases. This is a standard that's been out for a few years now, and we've presented this in the last couple of years in our not-for-profit presentations here. So I just want to go up very high level purposes and requirements again, just so everybody's on the same page, because this is coming up next year, and it will be effective for anybody that is a lessee. It will have that impact on you. Next one is audit report changes. The auditor's report is changing significantly. It's the first time in several years, so I want to go through some of those changes that you can expect in the auditor's report. And then the next one is the current expected credit loss model, or CECL. And I wanted to talk about the changes to the methodology for estimating credit losses. So on leases, the purpose of this is to increase transparency and comparability among organizations about leasing arrangements. So a lot of organizations may have leases or operating leases right now. You can think of, some organizations they may lease planes, or, think a lot of the bigger organizations that may lease big equipment. They have significant liabilities related to those lease obligations, but they're not necessarily ever going to show up on the balance sheet. They're basically going through the income statement of monthly payments they're making, and nothing ever shows up to indicate there's a liability. So the whole purpose of this standard was to increase transparency and comparability, so you can compare one organization to another organization and say, okay, what are their lease liabilities? If you're looking at two different organizations, how do they compare? So the whole point of this was to get lease assets and lease liabilities on the balance sheet for operating leases to allow for that comparability. So the lessee accounting and disclosures are significantly changed, and we will go through some of these changes here, but the lessor accounting and disclosures are virtually unchanged. So if you're a lessor, this really is not going to have a whole lot of impact. The lessees definitely will significantly impact you. This does only apply to leasing of property, plant, and equipment, and it does not apply to intangible assets, oil and natural gas, biological assets, or timber, and inventory and assets under construction. So there are two different types of leases. There's finance leases and operating leases. The finance leases you have to meet any of the following criteria, and you'll notice these are very similar to what current GAAP has for the capital lease criteria. I'm just going to walk down through here, and there are some changes. But if it meets any of these criteria, it is considered a finance lease. So the lease transfers ownership of the underlying asset by the end of the lease term. The lease grants the lessee the option to purchase the underlying asset that the lessee is reasonably certain to exercise. The lease term is for a major part of the remaining economic life of the underlying asset. The major part is highlighted because that is a change. It used to be a specific percentage. Now it is just major parts. So it is very broad, much broader now for you to define. The present value of the lease payments and residual value guaranteed by the lessee equals or exceeds substantially all. And again, substantially all is highlighted there. That used to be a specific percentage also of the fair value of the underlying asset. And then the underlying asset is of such specialized nature that it's expected to have no alternative use to the lessor at the end of the lease term. So if you're evaluating your lease and it fits any of those criteria, it is considered a finance lease. If it does not meet any of that criteria, then the simple definition for an operating lease is any lease that does not meet the criteria for a finance lease. So it has to fall into either finance or operating. You have to go through that step. That's your first initial step to determine whether it's finance or operating. So you say, what difference does it make whether it's finance or operating? And the difference is in how it's recorded. So the finance leases and operating leases, the initial recording of the asset and liability is exactly the same. For finance leases, you're going to have a right of use asset and a lease payment liability measured at the present value of the lease payments, and that's put on the balance sheet. That is the same with the operating leases. The difference becomes in subsequent measurement and subsequent disclosures in the financial statements affects income and cash flows. So on the finance leases, you're going to recognize interest on the lease liability, but you're going to do that separately from the amortization of the ROU in the income statement. And then on the cash flows, your principal payments are classified as financing, while your interest payments are classified as operating activities on the cash flows. On the right side, then the operating leases, that cost is recognized as a single lease cost, allocating the cost of the lease over the lease term on a straight line basis. So there's one cost that's going to go through the income statement related to operating leases. And then all of those payments are classified as operating activities in the statement of cash flows, which is similar to what we have now. So some general considerations when you are recording these, and this does need to be evaluated and recorded at the commencement date of the lease. So the initial lease classification should not be reassessed unless the lease is modified. So whatever classification you classify it as, that needs to stay until you have some kind of lease modification. The initial lease classification also needs to be reassessed if you have any kind of options or exercising of options to purchase those assets. You would need to kind of take a step back and reevaluate the classification of that initial lease classification. So when you are measuring lease payments in option periods, the payments must be reasonably certain to be exercised. Reasonably certain is highlighted there because it is a high degree of confidence that a future event will take place. So if you have a lease that has options within it, like a renewal lease that has 3 options, and you feel that you're not going to use those options, you have a reasonably certain you're not going to use those options, you would not include those options in your calculations for your lease payment obligation. If you had, say you had 3 options and you would only use 1 or 2, you would need to use those in your calculation, but then the third one would not get included in that calculation. So again, you need to kind of look out to the future and be reasonably certain about how sure you are that you're going to exercise those options and factor that into your lease payment calculations. So leases with a term of less than 12 months. The accounting policy, you can make an election by underlying assets not to recognize lease assets and liabilities on the balance sheet if the lease term is less than 12 months. However, I need to caution here, I've heard several instances where entities are just saying, well, I'm just going to make all my leases less than 12 months. Then I don't have to fool with it. I don't have to put it on the balance sheet. It doesn't apply to me. And that is true as long as that lease is truly less than 12 months. If it is truly a short-term lease, that's fine. But you also have to consider options within those leases. So if you rate a 12-month lease, but the intention is you're going to renew that for the next 5 years, you have to look at those options, and we revert back to the couple bullet points up above. How reasonably certain are you that you're going to do that? And if you feel you're going to do those options, then that really is not a 12-month lease. And it really does fall under the new lease standard, and it does need to be recorded as an asset and liability. So be careful with those leases that are under 12 months. It does give you a break on those if they truly are short-term leases, but if they are not, then you need to go back to this. So the lessee recognition and measurement, again, you are going to have a right of use asset that is an intangible asset. It's a right that the lessee has purchased and owns. It is typically classified as long-term on the balance sheet, and it is amortized over time. The other side of that then is the lease payment liability. And again, at commencement date, you're going to have to calculate the pieces that fall into that lease liability calculation. And you're going to have, there's bullet points here of the items. You're going to have fixed lease payments, any variable lease payments, any exercise price options to purchase the underlying asset if the lessee is reasonably certain to exercise that option, penalties for terminating the lease if the lease term reflects the lessee exercising an option to terminate that lease, and then any other amounts probable to be payable by the lessee under a residual value guarantee. So at the commencement date, when you're initially recording it, it's critical you capture all of these different expenses, payments, obligations within that calculation so that you get a good starting number for that payment liability to get that recorded on the balance sheet. And then, obviously moving forward, then it's much easier, but you want to make sure you capture all of these initially. So the discounting cash flow calculation is based on present value, and that does use a discount rate, which is typically based on the rate implicit in the lease. However, a lot of leases do not have a rate implicit in the lease. Some do, but most do not. So if you don't, you can use your increment or borrowing rate or the rate you are typically paying on your debt you have outstanding right now. You can also use a single discount rate to apply to a portfolio of leases if that rate is not significantly different from the individual lease discount rates. So you have some options here. And then the third one, the private company may make an accounting policy election to use the risk-free rate or the Fed funds rate. But you have to be careful because that risk-free rate will be lower than the effective borrowing rate. So that will increase your ROU and your LPL, and it will be higher than if you used another rate. So you do have that option for private companies, but you do need to be aware it is going to make that asset liability higher than what it typically would be using other rates. So along with many of the other disclosures requirements within the other recent accounting standards, this is no different. There are a significant amount of disclosures required related to leases. So qualitatively, you see the bullet points here. There's a general description of the leases, the basis and terms and conditions of which the variable payments are determined, the existence and terms and conditions of options to extend or terminate, narrative disclosure about options that are recognized as part of the asset and the liability and those that are not, the existence and terms and conditions of residual value guarantees provided by the lessee, restrictions or covenants imposed by the lessee, and if you have any subleases present, you also need to identify information noted above related to subleases also. So there's a significant amount of qualitative information. And then if you go to the quantitative information, it's even more. And this is daunting when you first look at this. It's like, wow, there's a lot of information here. And there is, but when you start putting this together, it kind of flows together into charts and tables. And it flows actually pretty well. And it's not as voluminous and as overwhelming as it may look. But you do need to disclose the total lease costs, including the amount recognized in the income statement and capitalized during the period, any variable lease costs, sublease income, cash paid for amounts including the measurement of lease liabilities, non-cash information of lease liabilities, weighted average remaining lease term, the weighted average discount rate, maturity analysis of the undiscounted cash flows over the next 5 years, a reconciliation of the undiscounted cash flows to lease liabilities, and amount of lease transactions between related parties. Now, again, this information is very similar to what we have done for the capital leases under current GAAP, but this is much more expanded than what we have done for that. And the key thing there is it's highlighted at the bottom. The above information is to be disclosed separately for finance and operating leases. So if you have financing leases and you have operating leases, you need to disclose all this information separately, one for financing and one for operating. You cannot commingle them and just put them all together. For disclosure purposes, they have to be disclosed separately for finance and operating leases. So that's one thing to keep in mind. So there were some practical expedients issued to ease the transition to the standard to get it, basically just to get the assets and liabilities on the balance sheet and make it ever easy for everybody as they were trying to initially put this standard together and get it implemented. So the first three bullet points have to be elected as a package. You have to do these consistently. So it does allow you that you do not need to assess whether any expired or existing contracts are or contain leases. You do not need to assess the lease classification of any expired or existing leases. So if a lease was operating before, it's operating now. If a lease is capital before, it's financing now. So that saves a lot of time as to determine the classifications. And then you do not need to reassess initial direct costs for any existing leases. But again, you have to do this as a package. So if you do it for one lease, you have to do it for across the board. You have to apply all three of these across the board. The second practical expedient then is you can elect to use hindsight in determining the lease term. So it does give you that option to go back and use hindsight, and you can do this separate from what you have done for the other three above. But again, there's a lot of leeway here. It's basically allowing you to move forward. What you have is what you have, and then move forward and evaluate them going forward instead of spending a lot of time going back. It's what they were finding is a lot of people were spending a lot of time going back through contracts. You can imagine some entities have hundreds of thousands of contracts to go through. It was a overwhelming task. So this was just a matter of here's what you have, get them on the balance sheet of what you have, and then move forward with and account for them correctly going forward. So again, these expedients were designed to reduce time and just get them on the financial statements during the transition requirements. So effective dates, this was originally effective for fiscal years beginning after December 15th, 2020, which was this year. Now it is, because of COVID, it was delayed until calendar year 2022 or fiscal year 2023. So it is effective for next year. So if you do have a significant amount of leases, this is something you want to look at pretty quickly because it does take some time, especially if you have a lot of leases to evaluate and get them booked and reported, because they need to really be reported on January 1, 2022. It does allow two different approaches. There's a modified retrospective approach, which requires recognition and measurement of leases at the beginning of the earliest period. However, another ASU was issued, allows another optional method. And again, this was just to ease to get it on the balance sheet and get get it basically in transition in when it was recorded. So you can initially apply this standard at the adoption date and recognize a cumulative effect adjustment to the opening balance. So if you're putting this on in January 1, 2022, you would basically put on the right of use asset and liability, and then whatever difference you may have goes through the cumulative effect adjustment and retained earnings. And then you basically just move forward. So comparative information before adoption will be presented in current GAAP, so you don't have to go back and recast to show that new information in previous financial years. You would just move forward. So in essence, with all these practical expedients, the lessees, you're basically just going to continue to account for the leases in the same manner you have done under current GAAP until they're modified. The only difference is you're going to have your asset and liability on the balance sheet, but you're going to continue. If you have operating leases, they're going to continue to be operating leases until a modification happens or until you enter a new lease. And then you need to sit down and evaluate those on a case-by-case basis as they happen going forward. So again, it was just to get things on the balance sheet for this transition and then make sure they're accounted for appropriately going forward. So the next topic then is upcoming accounting audit report changes. And the AICPA Auditing Standards Board in 2019 came out with a suite of changes to the auditing standards, which included SAS 134, auditors reporting, and amendments. So this standard that came out basically changes significantly the audit report, composition of the audit report, the titles, and basically how it's structured. And this was the major change, first major change in several years. So I just want to highlight some of these changes you'll see in the auditor's report. The major ones, the auditor's opinion is now at the front of the auditor's report. It adds more titles. It discloses management auditor's responsibility for going concern issues. It introduces key audit matters term and expands the disclosure of audits for auditor's responsibilities. So for each of these slides, I took snippets from an example report and put in here so you can see what each of the paragraphs look like in a sample, and so you can kind of follow along. So the opinion paragraph, as I said, is now the first paragraph of the report instead of the last paragraph. This really isn't that much different than it was when it was at the end of the report. However, basically it was included, everybody who goes to the auditor's report, they go to the last paragraph anyway, just to see what the opinion is. So let's cut to the chase and get it to the front of the report. And it'll be right there where everybody can see it. So again, we have audited the financial statements of the company, which comprise a balance sheet and the related statements of income, the cash flows for the years that ended, and the related notes to the financial statements. In our opinion, the company financial statements present fairly in all material respects the financial position of the company as of December 31st, and the results of its operation and the cash flows for the years then ended in accordance with generally accepted accounting principles. So again, that's not much different than we have now, but it is at the beginning of the report. The second paragraph then is a basis for opinion report, the paragraph which is included after the opinion paragraph. This was formerly included only in reports with modified opinions. So if we had a modified opinion, we would need to include this wording. Now it is going to be included in all reports. This does include information that the auditor has followed GAS, a separate section to describe the auditor's responsibility, a statement about required independence and ethical responsibilities, and whether the auditor believes the audit evidence is sufficient for the opinion. So we conducted our audits in accordance with auditing standards generally accepted in the United States of America. Our responsibilities under the standards are further described in the auditor's responsibilities section later in the report. We're required to be independent of the company and to meet other ethical responsibilities in accordance with the relevant ethical requirements related to our audits. And we believe the audit evidence we have obtained is sufficient and appropriate to provide a basis for our opinion. So some of that's similar to what we have now, but it does add additional wording that we do not have currently. The next sections are added as necessary based on audit findings or being engaged to do so. So the emphasis of matter paragraph, we've had this in the past, but it was typically toward the end of the report. This is for any matters you may need to disclose and feel the reader needs to understand. For example, here as discussed in note X to the financial statement subsequent to the date of the financials, there was a fire in the company's production facility. Our opinion is not modified with respect to this matter. Again, this isn't new, but the geography and where it is included in the report is different. Key audit matters is a new term that was added, but this is only going to be included in the auditor's report if the auditor was engaged to issue the communications on these. These are topics that include areas of higher risk of material misstatement, areas involving significant management judgment, and significant events or transactions during the period, among other things. But those are the typical ones. And these are things the auditor would typically discuss with those charged with governance during a required communications meeting. So while this is always being discussed with governance, it was never required to be put in the auditor's report. So if the client engages the auditor to issue these communications in the report, it does need to be included in this section. If they do not engage it, it does not get included in this section. So that's just depends on the circumstances whether that's going to be included or not. So management's and auditor's responsibility paragraphs have expanded titles and included more information. So the responsibilities of management. Management is responsible for the preparation and fair presentation of the financial statements in accordance with accounting principles generally accepted in the United States for the design, implementation, maintenance of internal control, relevance, and preparation and fair presentation of financial statements that are free from material misstatement, whether due to fraud or error. And this is new. In preparing the financial statements, management is required to evaluate whether there are conditions or events considered in the aggregate that raise substantial doubt about the company's ability to continue as a going concern for, and it's typically 12 months after the audit report date. So if there was any doubt about the condition of the entity to continue as a going concern, that would be a separate paragraph, but this is included here and in the auditor's responsibilities, basically identifying that management and the auditors are required to evaluate whether conditions or events considering the aggregate that raise substantial doubt about their ability to continue as a going concern. So that is new and was not there before. The auditor's responsibility paragraph then is also expanded to include new items. This is a significant section compared to what we've had in the past. There's just one paragraph. Now we have several bullet points. I am not going to go through these. You can read what these are, but it does, again, expand significantly what is included for the auditor's responsibility in the report. And as you can tell, the report is obviously longer than it used to be because there is much more information included in here. But this is the first change in several years to the auditor's report. So it's going to be a significant change. This was originally effective for periods ending after December 15th, 2020, but again, it was delayed by 1 year due to COVID. So now this is effective for periods ending after December 15th, 2021. So if you are a calendar year 2021, December 31st, your auditor's reports this year will include this new wording, and then any subsequent, June 2022 audit reports will also include that and anything subsequent to that. So basically, any upcoming audit reports after December 15th are going to include this new wording, so you can look for that in your auditor's reports. The last section I want to cover was current expected credit losses, and this is the acronym for this is CECL. It is not an uncle, it is not a person, it is just an acronym to describe this new standard. This was issued in 2016 by the FASB as a ASU 2016-03. So current GAAP requires an incurred loss methodology for recognizing credit losses. However, that delays the recognition until it's probable a loss has been incurred. So some of the downfall or the pitfalls of current GAAP is that it limits the ability to record current credit losses that are expected but do not meet the probable threshold. And this came to light in the late 2000s and the economic crisis of the 2000s. Primarily in the banks, where they were having all this turmoil within the housing industry and loans, but they were not recognizing as losses because they didn't meet the criteria for probable loss to be recorded within the allowances for loan losses. So that's where this standard kind of came from. It was primarily driven by the regulators for the banks, but unfortunately, it's kind of like the revenue recognition standard, and it was one standard that applies to everybody now. So this is going to apply to anybody that has any kind of trade receivables, any kind of financing receivables. This is going to apply to you, and you're going to have to, evaluate your allowance for credit losses within your balance sheet and financial statements. So, just because a nonprofit, I've read different things on this, nonprofits say, well, this doesn't apply to us, it's only for banks. That's not true. It will apply to nonprofits. If you have any kind of financing or any kind of trade receivables, you are going to have to evaluate this. So, there's a misnomer out there that this doesn't apply to, a lot of people, but it really does. It's going to apply to a lot of entities that don't realize it. So the standard's main goal is to improve the financial reporting by requiring early recognition of credit losses on those financing receivables. So this does require moving from an incurred loss approach or historical to an expected loss approach, which is forward-looking. So GAAP has always taken a historical loss. Whatever our losses are, that's what we're going to base our allowance on for our receivables. But this introduces a new concept of forward-looking statements, and you're basically pulling out your crystal ball and saying, what do I think like the economy is going to look like? What do I think this is going to look like to impact our receivables now that we need to be factoring into our allowance calculation? So it does require an estimate of the credit losses over the life of the exposure based on historical information, current information, and then reasonable and supportable forecasts. So you're going to look back, you're going to look current, and you're going to look forward to evaluate this and come up with a methodology to estimate that loss. CECL is very specific, though. The concern here when this came out was it was designed for large entities, and a lot of people were just going to ignore it because, well, CECL is designed for big entities, that doesn't apply to us. So they were very specific in developing a reasonable methodology that is reasonable for all entities and is scalable to all entities. So CECL does not specify a methodology for developing a reasonable supportable forecast, duration of period that losses can be forecast, precision required to support that estimate. These are all based on judgment. So as long as you have some kind of basis for how you're coming up with your calculations and your reasonableness of those estimates, they should be valid. But you're going to have documentation to support how you got there and what your rationale is behind all of those estimates and judgments. Again, GAAP requirement is explicitly scalable and allows preparers to develop any estimated methods that are appropriate and practical for their circumstances under this model. So this is designed from the smallest entity to the biggest entity. It is to be scalable, whatever makes sense for your size of organization, whatever you feel is appropriate to get those allowance calculations adjusted, that's what you need to do. And FASB does provide examples that illustrate this in a non-complex environment, in example 1 in the ASU. So again, loss history remains a starting point and provides a basis for the expected credit losses. GAAP does not specify a particular methodology for determining the historical credit loss. Again, you can use whatever historical credit loss information you want to use to get a good start, but you have to evaluate the nature of the receivables, and that method will determine the data needed for your evaluation. Historical data is still going to be adjusted, though, using the qualitative factors based on economy, loss trends, environmental conditions. You're still going to have to adjust that historical loss factor by other factors. So the forecast is probably going to be the biggest challenge to come up with a reasonable and supportable forecast for the future, which is required to be adjusted and figured out to go forward. So basically what you're going to do is you're going to disaggregate your receivable segments, and however you have your receivables, whatever buckets you use, however they're classified, you're going to take each one of those segments. You're going to look at the delinquency rates, trends, unemployment trends currently, and you're going to come up with some factors there of here's what we feel is an estimate of the loss within our portfolio. And then you're going to look forward using supportable forecasts of information based on the economy, our current work environment, our current even some ag can be forecast for farmers and that kind of stuff. There's a lot of different pieces you can look forward to that needs to factor into these calculations. So you need to factor that in some manner. Again, it's very broad. There's no rhyme or reason. There's no specific formula of how you're going to do this, which is going to be the biggest challenge. But for periods in which you are unable to support a forecast, you are required to revert back to historical loss information. But I think that's going to be the exception to the rule. Some other things to consider is you need to use your strategic plans, your budgets, your capital planning. You're doing strategic plans, you're doing budgets out into the future, you're doing capital planning for the next several years, but you need to make sure those line up with your other information you're using to come up with these forecasts that you're going to use within your allowance calculation. So this all needs to line up together and work in the same direction. So a lot of places where we get this data, some entities may begin with external forecasts from the Federal Reserve. They supply some data, trade organization data, federal local government data. There's multiple ways you can get data to, some forecast data. They will, here's what we think is going to happen. But again, that data is critical for your basis of here's what we're seeing, here's what we're thinking, and then adjust that to what you see within your organization, how that factors into your calculation. So this is not going to be an easy process. It is going to take some work and truly some documentation to support whatever rationale you came up with to get there. You're going to have that thoroughly documented to support that. So one of the main questions was, what if there are 0 expected credit losses? So the AICPA Audit and Accounting Guide did come out with some guidance that requires an estimation of the credit losses, even if the risk is remote. So you say, I really don't have any risk in my portfolio, I don't think I need to do anything. If an entity expects 0 losses after considering past credit history and reasonable and supportable for future conditions, no allowance is necessary, but you must reassess periodically and as conditions change. So I think this is going to be the rare case. I don't think this is going to be very widely used. So I think, there is a day one losses theory out there that basically as soon as you record a receivable, there's some kind of loss associated with that. Even if it's small, there's some kind of loss associated with that. Even if you have no delinquency, you have no other credit history of this that shows delinquencies, you're still going to have to factor in something of potential loss going forward. So I think this is going to be a rare occasion, but if it does happen, then you must reassess that periodically and make sure that the information you're using is accurate. So this is effective for non-public entities for periods beginning after December 15th, 2022. So it is 2023. However, as you can see here, there are a lot of moving parts. There's a lot of judgment here. So this is not something you want to wait until November 2022 and start thinking about, hey, what are we going to do with this? This is something to start thinking about now and coming up with some methodologies and how you can get there. Earlier application is permitted. We are not seeing that happening. A lot of places are holding on to the end to get it implemented. Again, it is not easy, but this gives you a high level view of what is required for that. Any questions?